In 1987, a 25-year-old Jordan Belfort walked onto the trading floor of a small brokerage firm on Long Island and learned the only sales pitch he'd ever need. It wasn't complicated. It wasn't clever. It was a lie so simple that it made him hundreds of millions of dollars before he turned 30. The lie was this: I have access to something you don't. That's it. That's the entire con, and it's the same lie still running through every pump and dump scheme, every penny stock scam, every crypto rug pull happening right now while you're watching this. Because the truth about the Wolf of Wall Street isn't that he was some evil genius, it's that he understood something most people still don't know about how financial fraud actually works. It doesn't require sophistication. It requires belief. Let me show you exactly what he did and why it's easier now than it was then. When Belfort started at Stratton Oakmont in 1989, he wasn't selling blue-chip stocks. He wasn't offering shares in Apple or IBM. He was selling what Wall Street calls penny stocks. Companies so small, so obscure that most of them didn't even have real businesses. They had names, they had ticker symbols, they had shares you could buy, but they didn't have revenue, products, or in some cases, employees. Here's how penny stocks work. A company issues shares to the public, but it's too small to list on the New York Stock Exchange or NASDAQ, so it trades over the counter. That means there's no centralized exchange, no real oversight, just brokers calling each other, making deals in the shadows. The stock might be worth 5 cents, maybe 50 cents. The companies are usually shells, concepts, sometimes just a guy with a business plan and a dream. And that's where Belfort saw the opportunity. Because when a stock is that cheap and that unknown, you can control it. You can decide what it's worth, not through analysis, not through fundamentals, but by pure force of salesmanship. Here's the actual mechanism. Stratton Oakmont would buy huge blocks of shares in a penny stock for almost nothing. Let's say they bought 1 million shares at 10 cents each. That's $100,000. Cheap. Then they'd call their clients. Thousands of them. Dentists in Ohio, retirees in Florida, small business owners who'd made some money and wanted to grow it. And the brokers would tell them a story. This company is about to explode. We have inside information. The stock is currently at 10 cents, but it's going to $5, maybe 10. You need to get in now before everyone else finds out. The clients would buy, hundreds of them, thousands of shares each. The demand would push the price up. 10 cents becomes 20, then 50, then $1. Suddenly, that million shares Stratton bought for 100,000 is worth $1 million. They sell, the price crashes, the clients lose everything. This is called a pump and dump, and it's illegal. But here's the thing, it only works because of that one lie. I have access to something you don't. The clients weren't stupid, they were just operating on the assumption that the person on the other end of the phone had better information than they did. Why wouldn't they? He was a broker, he worked on Wall Street, he had access. Except he didn't. He was the threat. Now, Belfort didn't invent this. Pump and dumps have existed since stock markets began, but he industrialized it. Stratton Oakmont wasn't a brokerage, it was a machine. At its peak, the firm employed over 1,000 brokers. They worked in a massive office that looked like a nightclub. There was a brass band, a dwarf-tossing competition. Brokers made millions in commissions. The top earners drove Ferraris and bought mansions in the Hamptons. And every single dollar came from clients who believed they were getting a deal. Belfort trained his brokers using a script. He called it the Kodak pitch because it was so automatic you could repeat it in your sleep. The script had psychological hooks built in. It created urgency. It flattered the client. It made them feel like they were part of an exclusive club. And it always, always ended with the same line. What's your credit card number? The brokers didn't need to know anything about the stocks. They just needed to believe in the pitch. And the pitch worked because it tapped into something primal, the fear of missing out, the desire to be on the inside, the belief that somewhere out there, someone knows something you don't. Here's the uncomfortable part. Belfort made around $200 million doing this. He went to prison for 22 months. He paid back about $11 million in restitution. That means he kept the rest. He now makes money as a motivational speaker, teaching people sales techniques, the same techniques he used to defraud thousands of people. And the clients, most of them lost everything. The SEC estimated that Stratton Oakmont defrauded investors out of more than $200 million. But that's just the documented losses. The real number is probably higher, because most people who lose money in penny stock scams don't report it. They're too embarrassed, or they don't realize it was a scam until years later. But here is what should actually disturb you. The system that allowed this to happen hasn't changed. It's gotten worse.